Inflation is top of mind for many in 2024, and joining me to share his expertise on this important topic is Dr. Michel Leonard, adjunct faculty member at New York University's Economics Department and chief economist and data scientists at the III, a sister organization to the Institute's Griffith Foundation. Uh, Dr. Leonard, I welcome your thoughts on the impact of inflation on the insurance ecosystem and on the public policy questions that come to the fore during periods of high inflation. But before we delve into these topics, for those public policymakers who are new to economic concepts as they relate to insurance and risk management, would you help them to better understand the term inflation and perhaps to talk a bit about some of the well-known indicators of inflation, like the CPI, for example?
Absolutely. Again, thanks so much for having me. Always a pleasure. Inflation, we all know what it is. We all know what it is when we go to the grocery store, but sometimes it's important to take a step back, kind of think of the economic concepts and the terms. So the main term out there is CPI. What does it stand for? Consumer Price Index. So that's the term that most economists use. What's the CPI? It's an index. It means that about 50 years ago, it's been around for about that time, a bunch of economists in DC thought we need to have a sense of what inflation is across the country. And they decided to come up with an index. We economists call it a basket. And it's a basket of goods that's supposed to represent what a traditional household, it's the consumer price index, a traditional household will consume. So literally at the time, it's what we call a survey based. So the Fed, the folks in DC would call the San Francisco Fed. They would call the Fed in Texas and in other parts of the country, in Atlanta, for example, and they'd say, what do you see there? What's the price of butter in your state? And then they would compare it. By the way, funny fact there for your audience, to this day, the Fed in San Francisco is up the hill from Market Street, and there's been a grocery store there at the corner of that Market Street, and they're still using the same grocery store for about 50 years. It's now a Safeway, but they're still using it. So that's called the Consumer Price Index. There's the same for companies, for corporates. They call it the Producer Price Index, the PPI. It's exactly the same thing, except of doing it on the consumer side. When you get to the grocery store, they're going to go to the farmers, for example. In that case, they're going to go to the manufacturer. They're going to say, how much do you pay for this and that good? So those are the two main things. Now, that's how we measure it. What are we measuring? Well, inflation is prices. Okay, good, great. But what does that mean? Economically, it means that prices are set. We may recall that from Economics 101, from supply and demand. So we economists believe, all things being equal, it's actually the main thing we've learned as a science in economics. We've identified the relationship between supply and demand. So the more demand, prices tend to go up, the more inflation. And that's why it goes into interest rates. Interest rates is what drives consumption. Cheaper money is, i.e. interest rates, the more we can consume, the more expensive it is, the less we consume. So that's why we look at CPI, that's why we look at PPI, and that's why it matters. So at the end of the day, if folks want to know what it means, go to the grocery store, look at the prices, and then think of all this mechanism down to Chairman Powell, or back then, Greenspan calling the Fed, and now I'm sure he has someone doing it. Actually, apparently the chairman, Frank, was doing it himself. He liked to do that, calling that specific one Safeway in San Francisco.
Thank you, Michel. Stepping back a pace or two from 50,000 feet, how would you describe today's inflationary environment? And could you help to put that perhaps into historic context for our audience? I think that'd be very helpful for our folks.
Absolutely. Well, let's start with today. Right now, we are coming down from a period of comparatively high inflation. Those are the terms economists like to say, comparatively high by historical standards. Sound like an easy quote statement. What does that mean? Well, the historical period, are we talking 50 years? Well, over the last 50 years, inflation has been about 3 to 4% in the US. The problem is that in the last 20 years, since, let's say, the 1980s and on, we've had what we've called cheap money. There was a lot of growth, but inflation was limited. Interest rates were low. So over that period, it was about 2% inflation per year. It adds up after 10 years and so forth, but it's still fairly stable. That was really good for retirees with pensions, with fixed income and so forth. In the last few years, because of the pandemic, may recall, we went all the way to 8% across all goods. So we're coming back down to, hopefully, right now we're at 3 to 4%. We're coming back down to that 2% target. The question, of course, now, to your point, is this going to be again 2%? Are we going to again be at 3%? What's the new historical trend here? And frankly, a lot of economists, including folks at the Fed who look at this, are thinking that historical 2% probably a bit lower than what we've had. So if you're all planning for retirement or for sending kids to school, also just thinking about insurance and other issues and replacement costs, probably 3 to 4, 2.5% to 3.5% is what we're going to have year over year.
Thank you, Michel. Very helpful to have that context. Perhaps we can spend a few minutes and narrow our focus a bit now, narrowing down to the risk management and insurance realm. I greatly appreciate your thoughts regarding how inflation is impacting the various members of the insurance ecosystem. And maybe a good place to start might be to look at the impact of inflation through the lens of insureds, a topic that's made headlines in recent months, to be sure. Welcome your thoughts there.
I think if, all of us, when we purchase insurance, our homes, our small, large businesses and so forth, it's going to be more expensive. And one of the reasons it's more expensive is because replacing goods and paying the services that go with replacing, rebuilding those goods is more expensive. As we were mentioning, inflation has been 8% at one point in the last few years. For some insurance lines, it was even higher. At one point during the pandemic, 2x4x8s wood that goes into the walls in homes was 3 or 4 times as expensive. It went from $2 before the pandemic to at one point $10 for that piece of wood, for those joists in the wall and so forth. It's come down a bit. So inflation for us as insureds, that means we're going to, we have somehow to make sure that carriers are able to pay those costs, because we want to make sure the carriers are there to keep paying for us as well when we have a claim. So that's the main impact here. Now, it's impacting different lines differently. And as we come out of the pandemic and things quote unquote go back to let's call it an elevated normal, so that 3% average there, inflation year over year across board, homeowners, a lot of costs there, probably most significantly impacted. Then when we're looking at commercial, on the commercial side, there's also concrete. There's a little bit of politics there, geopolitics, what's happening in Ukraine, concrete bonding agents, and so forth. Not to get too technical here, but for us, what it means as buyers and as carriers or reinsurers, it means that our costs are a bit higher, and they're going to stay a bit higher. That's not the only reason why insurance premiums are going up. There's a lot of other reasons out of everyone's control, but that's one of the factors.
Thank you, Michel. And very briefly, can you speak a little bit more to the impacts of inflation and how they're touching both the liability and asset sides of the insurer balance sheets? Very quick overview there would be helpful, and appreciate you've touched upon a couple of things already.
Higher inflation normally leads to higher interest rates, so that supply and demand can equalize the price and try to bring it down. The goal is to have low inflation. It's better for everyone. Now, other side, carriers, reinsurers, and so forth have a lot of money under management. That's how the bulk of income comes about. And traditionally, that's in very low risk. Government bonds, municipal bonds, and so forth. As a result of that, traditionally, when interest rates go up because of higher inflation, it helps carriers generate more income, and that's good news for everyone because it also puts also relieves some of the pressure on rates indirectly, but it helps a bit. On the other hand, if inflation comes down and interest rates come down, traditionally that puts some negative pressure on the ability of carriers to make money. Like all of us, there's less bonds coming out of that CD or that government bond, that New York bond, and so forth. And but in this environment, folks should feel much more comfortable. Though carriers have learned to operate for 20 years in the quote unquote low interest rate environment, so we're in a good place. The industry continues to be well capitalized, and the industry continues to be well positioned, whether interest rates are going up or down, to live up to all of its obligations.
Thank you, Michel. Given all that you've shared, in your view, what are some of the questions before lawmakers and regulators of insurance today?
I think the main question is how we all work together to address affordability and availability. And I think we've been, at III at Griffith, really available there to explain how these dynamics of inflation, of interest rates, and so forth come about. But folks also need to think about how can we as insureds, take a bit more control over our risk profile. I live up here in New York State, about an hour and a half from New York City. Even here we have extreme weather. Even here I had to take some steps to mitigate my exposure to flash floods and so forth. So that's one of the main issues. How do we, as regulators, as consumers, buyers, insurers, and insurers come together to provide a solution to continue to have affordable and available insurance?
Dr. Michel Léonard, thank you for joining us. Appreciate you speaking about inflation and its impact on insurance with the audience of the Griffith Foundation.
It's always a pleasure to speak with you and to have the opportunity to be in front of your audience.